Welcome, everyone. It's time for an exclusive episode. I thought I was going to do another public one today, and I just didn't feel like it. I thought I want to do an exclusive. I want to be able to dive into a subject that's not quite ready for broad appeal on the YouTube channels. I want to dive into Uber, DoorDash, a little Waymo, a little discussion between these type of businesses, and overall how I view Uber, why I'm not buying it right now. Just all these different questions. But a lot of this is actually going to be focused on DoorDash as well, because we've talked so much about Uber. And one of the companies that's been on my list for a long time that I actually owned at one point, I sold it at a small position, but I still just see such a prosperous future for it is DoorDash. And there's reasons why I think it might be still an interesting stock. So I want to look at DoorDash as well. Now, first of all, let's go ahead and just address the elephant in the room. Uber dropped 10% yesterday on the news that Waymo announced that they're going to Miami. Okay. So Uber is recovering a little bit today. It's up 1%. But if we look at the past week, if we zoom in here, you'll notice the big drop from $72 to $65, a 10% drop, down 9.6% on the week. Now, some Tesla investors and popular accounts on Twitter are saying that's because of full self-driving version 12, the new full self-driving. That is not why Uber dropped. It dropped because of Waymo. It even says it right here on Qualtrim. This is an API that looks at what happened during a stock price change. The event that happened during this stock price change is it happened immediately, immediately after Waymo announced on a blog post that they're launching Miami in 2026, Uber dropped. Now, a lot of you might read this and you can go through the whole press release and you can say in 2026, so like a year and a half, 2 years, and Uber's dropping today because of something that's going to happen in 2 years. No, you see, it's not just the announcement that Waymo is opening in 2026. That's not why Uber dropped, and Lyft for that matter, but we're talking about Uber. It's not just that announcement. It's a subtlety in that announcement. Waymo announced that they're going to operate in Miami in 2026. And they excluded Uber out of that launch. They said it's going to be through the Waymo One app. So it's not the news that they're launching in a new city. That's not problematic for Uber. It's the news that they're seemingly making plans to distance themselves from Uber, that they're not partnering with Uber. So obviously, even though that's years in the future, it's kind of a problem for Uber if Waymo doesn't partner with them, if Tesla doesn't partner with them. The whole story going down the road for Uber is that these companies will partner with them. So no, it's not just that it's in 2026 or, people look at it the perspective, it's a long ways away. It's the fact that Waymo is launching in new cities and they don't have plans right now to partner with Uber. Now, looking at this news, the reason that I don't, even though I think Uber is still undervalued, there's a couple reasons why I don't have it in my portfolio. And one of the reasons is simply because I just look at the portfolio and things are going so darn good right now. I look at the story fund. The gains on the story fund are insane. We have year to date, the gains are $97,000 this year. So up almost $100,000 this year, $118,000. This has been the year that Netflix has taken off, that Amazon has taken off. Now Netflix is up over 100% from my cost basis, but up hundreds of percentages from when I bought it in the low. My running rate of return on it is incredibly good, especially when you compare my Netflix return against the S&P 500. We have Amazon here that just this year, it pulled from being basically flat. Now it's starting to go up. It's starting to soar. Why is Amazon going up? Because Amazon has Jeff Bezos, he's not selling shares anymore. And they had their big AI presentation where they showed specific examples of how AI is transforming Amazon's business. Netflix is going up because they're gaining tens of millions of subscribers throughout the year. They're gaining so many customers. Their scale is enormous. They're venturing into live streaming. They have so much content this month. It's December. People are at home. They're watching videos and they're watching Netflix. They have generating $7 billion in free cash flow. They're buying back shares. The sky's the limit. So these companies are now going up. The investors are trailing in. They want to get into the best prized assets. And I use that term prized prized assets. What I'm talking about are the best companies in the world, a special breed of companies that don't exist anywhere else, that they often get ignored, but even when you buy them a little bit higher, a little bit lower PE ratio, it doesn't seem to matter if you're within the realm of realistic valuations. As long as you're somewhere in that realm, these companies get valued rather highly over time. So when I look at these companies, they're generating growing profits, growing cash flows, improving margins, more customers. They're taking advantage of AI and the price is going up. The Story Fund is now on a money-weighted return. It's now up 50% year to date, 5-0. So just crushing it. When I look at this compared against the S&P 500, this is what it looks like. The Story Fund now has a total return of 80%, while the S&P 500, if I invested at the exact same time with the exact same amount of money, has 53%. That's around I think it's around $35,000 difference between what I have now in this portfolio and what I would have if I had invested in the S&P 500, around a $35,000 difference. Now, when I look at this, there's a real realistic possibility here that I will double the returns of the S&P 500 for over the next year. So when we look at this, we could be at 100%. We're at 120. The S&P 500 is at 60. I think that's a possibility. And I say that because these companies have the compounding ability. They're growing earnings so quickly, and that's going to continue. So part of the reason I'm not buying Uber is I'm looking at my holdings list. If I was to buy Uber in the Story Fund, is Uber better than Netflix? Is it better than Amazon right now or Google? It might be a little bit better than Microsoft. It has more growth potential, I guess, than Microsoft. But then we have S&P Global. To me, these are the most bulletproof companies in existence. The only one that even has a question around it is Google. And Google's making gobs of money right now. It's making boatloads of money. So when I look at this and I'm trying to evaluate, does Uber strengthen my portfolio or does it kind of diversify it just for the sake of diversification? Is it any better than the companies I already own? It's hard for me to say it's much better. I'm much more convinced of these companies than I am of Uber right now. Even though I think Uber is probably a good bet, I think 90% chance it goes up. I'm not quite as convinced as I am with these ones. Now, in most cases, what I'll say is most companies that I cover, but I don't buy because I have some little concern, they typically do well. Just the realm of companies I cover tend to do well. Go back and look at all the ones. Look at all the companies. Chipotle's coming back up. It does well. It's a company I've owned. I really like it. It's going to do well, whether I own it or not. So ones that I've owned or I don't own, ones that I cover, look at DoorDash. That's one that I owned and it came right back. These companies typically do well, even if I don't own them. Another example of this right now is Adobe. Look at Adobe. This is one that I had concerns about. I don't own it right now, but it's going up. In fact, if we look at it year to date, today it's up 50, I think a 52-week high, up another 2.71%. Hasn't done great this year, but this company is probably going to do well, even though I don't own it. A lot of other companies that I don't own have started to come back up. But again, I'm working with a pool of very high quality companies. Most of them are subscription companies, strong recurring business models, very high returns on assets, very huge total addressable markets, just massive global markets. Most of them are going to do well. And I don't believe that Uber is any different. I just keep coming back to the fact that when I compare it against my existing portfolio, I don't want to keep adding on name after name after name. So I have 50 stocks in my portfolio. I want to keep it very concentrated. When I look at my current portfolio, it's just crushing it. These stocks are doing so well, both fundamentally and with price action. The price is going up. The fundamentals are going up. I like what I see here. And the thought of adding on another holding is very difficult unless I am 100% convinced it's going to be an excellent bet. And with Uber, there's a couple things that I think 90% chance it's going to do well. So 9 out of 10 scenarios in the future, I think it will do well. But there is a situation where I think Uber struggles. And that is if one technology, like Mark Mahaney says, if one technology wins out big. Let me put it this way. I own Google, which owns Waymo. If Waymo just controls and dominates this whole field, if Tesla takes another 5 or 6 years, to get to really full self-driving that's approved and regulated and mapped out everywhere in the US, if they take 6 or 7 years, Waymo might control the top 20 cities in the United States. Now, Uber operates in tens of thousands of cities. So is it a problem if Waymo only operates in the top 20? Well, look at the concentration of population density within the US. The US is highly concentrated into a number of cities. Then there's lots of areas that are farmland. I go driving some areas around Colorado, Utah, Nevada, where you can be driving 100 miles an hour. You can go for an hour and not see a single home. So there's some areas where there's not many Ubers, there's not highly populated areas. And then there's areas like Vegas where there's just all the population. Or you go to LA and there's all the population in one dense city. And those are the cities that Waymo's opening up. They're opening up in the most densely populated cities within the United States first. Because once they map out those cities, that gives them access to around 20% of the US population. Just with a handful of cities, 20% of the US population. And if Waymo just takes over, and in this scenario that Tesla's way behind, Waymo will have all the control. Google will. They won't have to go through Uber. They can just have people use the Waymo app, right? They have their own app. Google can do things to try to push users to the app. Google knows how to scale applications. They've done it a million times. That's not good for Uber if Waymo wins. We can take the other side of this. Again, I own Google, but let's say that Tesla wins. Tesla this year, or next year, I'd say. They launch their full self-driving. They start getting city permits. They launch their Robo-taxi. Before we know it, they're just everywhere. Let's say by the end of 2025, Teslas are driving themselves with no drivers in the driving seat everywhere. In that scenario, I'm not that hurt with Google. Waymo makes up a tiny percentage of Google, so it doesn't really bother me as a Google shareholder. Tesla is doing great, so Tesla investors would be happy, but Uber investors would lose in that scenario. They'd face new competition that's very difficult to be competitively priced against. So in the scenario that either Waymo wins or Tesla wins, that's not good for Uber. And then I also see a third scenario where let's say that Waymo and Tesla both kind of share the market of selfless no drivers, right? Of Robo-taxi. And, then Uber wants to partner with one of them, but both of them don't want to do a partnership that's great for Uber. It's worse economically for Uber. So Uber gets kind of boxed out from the Robo-taxi network, and then Uber has to go to like a third party. Maybe Zoox from Amazon. But let's say that Zoox doesn't control that much of the market. So Uber's in this weird position where it's having to partner with like the third placed partnership. So I'm just looking at all these scenarios. And again, I think the most likely scenario, nine times out of 10, is that Uber does partner with one of the big ones. Like number 2 or number 1. Probably not Tesla. I don't think they're going to. But they might make some type of deal to use their app to get demand and all of that. I think that would be most likely that they partner with Waymo, they partner with Zoox, they partner with Tesla. But there is a chance that it's really difficult and it pushes down the margins of Uber because they get a less economically beneficial deal. And since I am not 100% confident with that, I'd rather stick to companies that I own currently, that I've done a lot of research on, and I feel like there's a very good probability over the next 5 to 10 years they're going to do really well. But again, my thoughts always change. So these are the things going through my head. It's the reason why I'm not buying Uber right now. Not so much because I'm concerned about the company. Again, 90% chance I think it'll do fine. It's more that the quality of the companies I already own are so high, and I don't want to just add on names of any company that's dipped. I want to make sure it's a company that dips that I really want to get in my portfolio, that I think raises the quality of my portfolio. When I look at the trades I've been doing, overall, the aggregate quality of my portfolio has been going up. And I don't want to make changes that are horizontal changes, swapping out one high quality company for another. I want to have quality go up. So we'll see those changes over time. Right now, I think Uber's a good bet. I don't blame anyone for buying it, but that's my thought with it. Now, if we look at another company that I think is ignored on our and I can't convince people of this one, but it gets ignored a lot, and it's DoorDash. Before I go into the metrics of DoorDash, I just want to share some overall thoughts on it. There's a segment of the population that's higher income. Let's say you make over $80,000 a year, okay? If you In many cases, there's like one member of the household making 70K. Maybe there's 2 working adults in the household. You can pull in 150,000 a year with 2 working adults. It's a very common situation. If you both have moderate good jobs, one of you makes 100K, one of you makes 45, 50, or both of you make 70,000. That's a pretty good income. 150,000 for a household. And then there's households that they make much more. There's 2 working adults. In those cases, those people earn enough money where they don't have the luxury yet of having a private chef. Okay, so private chefs are for hedge fund managers, big wigs, VC investors, people that live in New York City in the high rises. They have multiple millions of dollars, right? They're making mid 7 figures or above per year, and they can hire someone to live full time with them for 80,000 a year that has a gig of just cooking for their family. They make private chef meals every morning, every lunch, dinner, that type of thing. That's a whole segment of society that's very small. You're in the super fraction of a percentage there. But below that, there's this bigger segment, swath of society, that can't afford that. They can't afford the private chef, but they'd love to have some benefits of a private chef. The ability to have a meal appear to them that they don't have to prepare themselves. That's something they want, that they know they want, that's either healthy or tasty, but they want it without having to work for it. That is what DoorDash offers. It offers a leap between that big gap of buying a private chef to live, paying a private chef to live in your house and not having anybody serve you food at all unless you go out and get in your car and drive and pick it up. There's a middle ground there that's very big, and DoorDash covers that middle ground. Now, DoorDash is not just for high-income people as well. There's an area of medium income, right? We're talking about people that just make the average in the US that still like DoorDash once in a while. They don't use it every day or every week, like having a private chef 24/7. But on weekends, if they want to get a drink delivery, if they're at work, they can do group orders and have DoorDash pick up all their work or pick up drinks from them or desserts or whatever. There's a group of people that do that as well. And one thing that I've noticed throughout investing is that things that require patience and struggle and strength and discipline are very difficult sales to make. So Peloton, that requires discipline, strength, keeping up with your health, getting on a treadmill and cycling, or getting on a bike and cycling, that's very difficult to keep up. That's a difficult sale to do, to get people to do that. Things that only require impulsiveness and leisure, making people's lives easier, more convenient, that's an easy sale. We love that. People love that. Americans love that. Europeans love it. Anything that makes your life a little easier. You might say, oh, these are lazy people. No, that's human society. We want to have pressure points and friction reduced in our life, and things that make life easier and more leisurely, and they offer convenience, quickness. Those things have an immense value. Look at fast food, right? Not all of it's bad. Look at Chipotle. It's food that's really fast to get. You don't even have a drive-through really. You just pick it up. That stuff does really well. I look at Netflix. Netflix, you don't have to require anything of people. You just have to require that they want to be amused and entertained. And for a cheap price every month, they get an enormous amount of entertainment. So those type of propositions do really well. And they have immense pricing power. That's how Netflix has been able to raise prices for over a decade every single year and still gain subscribers, have their average revenue per subscriber go up like crazy. These type of products offer convenience, have pricing power, and people pay a lot of money for convenience. We see that with all different aspects. You can look at virtually any aspect. People put a high price on convenience. So when I look at DoorDash, this is a company that I just want to go through some notes I wrote down on it. We'll just read through this together, but I think that gives a little bit of a preface. When we're breaking up what DoorDash actually is, DoorDash is a last mile logistics business that connects merchants, customers, and dashers. The DoorDash drivers are the dashers. And it connects all those parties together. So you have merchants, customers, and dashers. 3 separate parties that they're connecting together. Feels very similar to MasterCard, connecting merchants, banks, and the entire network together, customers together with merchants and banks. So you have these separate parties that they are networking together. That is the core of DoorDash. The primary focus of the company is food delivery and takeout services, but the service has expanded to other categories like a grocery. They will deliver products from places like Target, Dollar General, convenience stores like 7-Eleven, Walgreens, CVS, or their cloud convenience store, DashMart. So in cities, they're making this cloud store that you can't walk into, you can just dash things from, and has super low prices. You have beauty with partnerships like with Ulta Beauty. You have pets, the category of pets. You can now get your pet food delivered from Petco or PetSmart. So they started off with food, just delivering meals, hot meals, but now they've spread out everywhere to all the different categories of last mile delivery. You can get everything around your city, around your neighborhood, shown up at your doorstep within half hour from one aggregate app. That's very powerful. And the way that they've expanded and the aggregate demand they have is quite incredible right now. How did DoorDash grow? Well, there's a lot of factors into how DoorDash is growing right now. A lot of this transfers over to Uber, but specific to food and this company. First of all, the restaurant industry, or rather the food industry, is legitimately massive. One thing literally everyone does on planet Earth is eats food. Multiple meals every single day, their entire life until they die. We're talking about a total addressable market in the range of trillions in revenue per year. So the idea that restaurants will be bigger than food delivery, I really don't see as much of a concern. So when we're looking at this, the TAM that you're talking about here with food is always large. It's kind of like grocery, right? But with restaurants, the TAM in and of itself is massive. Restaurants are one of the best businesses for any type of mall. They're considered anchor tenants when you have a good restaurant. Restaurants they're so popular all throughout society, being able to gather together and eat food. And restaurants also offer a great amount of convenience. So we have this combination of the restaurant industry existing as this massive TAM, but nothing has combined the entire restaurant industry together. Nothing has aggregated that demand for delivery. Every restaurant company's doing their own separate thing. They have their own delivery apps. You got the Domino's one, or this one or that one. And that makes it very expensive for delivery. So if you could have an app that combined all of it together, that had a system with drivers, dashers to deliver all the food, and there's enough concentration of demand that it lowered the cost through scaled economics, that could make this a really big concept. Over time, another reason why DoorDash is growing is because over time, societies get wealthier. The US GDP per capita marches up every decade, lockstep. Look up the Fred analysis. US GDP per capita, we're getting richer. You might not notice it. You might still I got a lot of bills or there's inflation, but we are getting richer when you measure the amount of leisure, the amount of money, the discretionary money that people spend. As a society, we're getting wealthier every single decade. DoorDash, as societies get wealthier, they always trade excess money for time and convenience. So you have your basic necessities that you need to function. You need a car, you need a place to live, so you got rent or your mortgage. And then beyond that, once you have the basic necessities and you have a few physical comforts, the next thing that people start buying is leisure. They buy leisure and entertainment. They buy vacations, booking.com. They buy food, Chipotle, Texas Roadhouse. And they buy convenience. I don't want to work. I don't want to go and pick up food. I don't want to make a meal tonight. I'm going to DoorDash. That is leisure. You're trading your excess GDP per capita for leisure. And you can see the leisure economy grow like crazy as GDP per capita gets past that basic necessity to live. Now, if all of us were struggling to really live, these leisure products would not be doing well. But that excess capacity to spend, that excess money from consumers always makes its way after buying physical goods. It goes to leisure, goes to experiences. DoorDash can be viewed as a new major shift in the calculation of money traded for time and convenience. And it may start off as as only being viewed as irresponsible use of it, but over time, it will become a totally standard part of daily life. That's the argument that I'm making. Food delivery is looked at as only something for the wealthy, something for people that are either fat or lazy or wasteful or whatever, all these kind of derogatory terms to kind of downplay it, like you're doing something bad if you're ordering DoorDash. The same thing, I've seen it a million times. Everything that starts off as leisure gets viewed that way to begin with. Over time, the tempo is going to change. It'll become more and more commonplace. Friends will start doing it. You'll do it at get-togethers. You'll have workplaces do it. It'll become more socially acceptable. After enough time and enough money that people are making, this is going to become completely standard part of life. Some companies are going to capitalize on this concept of food delivery. Right now, DoorDash is a rather big leader, but we'll look at that in a second. Millennials order food and grocery delivery at roughly double the rate of boomers. Similar differences among age groups were seen in use of home delivery, with 65% of Gen Z and 62% of millennials saying that they have received home deliveries of grocery in the past 6 months, versus 45% versus Gen X and only 36% of baby boomers. Baby boomers have probably more reason to get grocery delivery, but the people, basically, the younger you are, the more that you're ordering DoorDash and grocery delivery, the more accustomed you are to paying a little extra for leisure. Every bit of data backs that up. Every single younger demographic is more willing to pay for stuff like DoorDash, Uber Eats, grocery delivery from Walmart.com. They pay for convenience. It's more socially acceptable. And that's how times change. This is going to become more commonplace. It'll be mocked and considered wasteful. And then younger people will do it. You make more money, GDP will grow, the scales efficiency will scale well, the prices will be lowered, and this will become more commonplace. Food delivery is also widely used by disabled communities. So there's a lot of people that do not like going out in busy restaurants. They don't like going out in busy situations because they can't. They're disabled. That population has enormous uses for Uber Eats and DoorDash. If they ever want to get a non-home cooked meal, they typically use these type of services. So they also have super repeat customers with that entire population. And again, it's a good thing. It's something that can serve them so they can get some food that they normally wouldn't be able to. So we're looking at a new era of convenience. DoorDash is best situated and the most advantaged company to capitalize on this long-term trend. When I look at this, let me bring up here let's see if I can download this image here. Okay, let me open it up. This is a chart that shows, it should show, yeah, here we go. So this chart shows the meal delivery market share, observed monthly sales. So this is like third-party analysis. And this gives you an idea of the scale that DoorDash is currently operating at. Uber Eats controls 23% of the food delivery market. DoorDash controls 67%. DoorDash's market share is actually growing, not shrinking. So even though they're the biggest, they're continuing to gain market share. In this new paradigm shift of leisure, trading money for time and convenience, DoorDash is at the lead of it. Now, you know me, I like companies that have the already existing dominant position. They're the most likely to maintain that position. They have to do something really bad to lose it, or the competitor has to do something really good to change the dynamics. Because in these type of network businesses, it's going to be hard for people to switch off of DoorDash to Uber Eats. Uber would have to get more drivers to offer faster times, lower prices. They would have to get people off of their Dash Pass, which there's like 1 million people using. So a lot of DoorDash users that use it the most use a monthly membership, which has a little bit of a switching cost. You don't want to pay for a monthly membership here and then use the other competitive service. So a lot of this is the market share can trade around, but right now DoorDash is winning. Now, here's the way that a typical order works. And I have a few more minutes to go through this. How DoorDash works. You have an order that's, let's say, $30. It's about a typical order. The Dasher will keep around 25%. So the Dasher is the person driving to pick it up. That's $7.20. The restaurant will keep around 60%. That's $18. And DoorDash will keep the rest 15%, which is around $4.50. Now, DoorDash's profit is not $4.50, because they have to pay for their whole business, all the employees, all the staff, refunds, all this type of stuff. So DoorDash only makes like 50 cents per order. They're not making hardly any money per order. And so far the company has been like barely even profitable, right? It's one of these companies that's losing money one quarter, barely making it profitable. But we've seen this happen before with Uber. Uber was losing money on every ride, right? It looked like a really bad business. And then they just work their way through scale to profitability. And the numbers get pretty wild if you even assume that DoorDash can make $1 per order. Just $1 per order, DoorDash is widely profitable. Super profitable company. Now, based on these are rough metrics. Again, the Dasher keeps 25%, the restaurant keeps 60%, DoorDash will keep like 14 to 15%. This is on an order level basis. DoorDash has a lot of central overhead and infrastructure that eats into that 15% order level profit margin. These numbers are also likely to change around over time as DoorDash optimizes the party's take rates based on scale. So the amount that each party gets will change when DoorDash grows and grows and grows, which they're doing because they're growing in the amount of users and order frequency. Now, finally, when I look at this, let me just show you some of the numbers here. They're pretty startling. When we bring up DoorDash, we have a couple of KPIs, which are specific things that we track on Qualtrim. First of all, we can just look at let's look at the trailing 12 months revenue. Always a good thing to look at. Look at that beautiful revenue, growing 24.5%. It's around 25% year over year based on the most recent quarter. But then we look at the orders, just the number of orders. This isn't trailing 12 months. This is just the number of orders every quarter. In 2019, it was 82 million. So in a 90-day period, they got 82 million orders. Now, in a 90-day period, last quarter, they got 643 million. Let me just repeat that. 2019, 82 million orders in a 90-day period. Last quarter, 643 million. They're growing the amount of orders by like 18 to 20% year over year. Every quarter, it's going up. The pandemic, it spurred growth. Of course, people started using DoorDash, but it didn't even slow down. It just kept going up. So there's no pandemic give back. The order frequency, the orders continue to go up because more customers, more order frequency. When people realize how convenient it is, they'll pay twice as much. They'll pay $17 for a burrito when they don't have to go out and get it themselves. It's trading money for convenience. When we look at the gross order volume, the numbers here are startling. Again, this is not the trailing 12 months. This is just quarter by quarter. 2019, 2.5 billion. Quickly raced up to 7 billion in gross order volume. And then now it's at 20 billion. Now, an interesting thing is that DoorDash is actually much cheaper than Uber on a gross order volume basis. So if you were to price the company on the price of the total market cap of the company and look at that in comparison to the gross order volume, DoorDash trades at a much cheaper multiple. That is because right now, ride hailing is much more profitable on a per ride basis than DoorDash is on a per ordering food from a restaurant basis. Right now, DoorDash has a more profitable on a per unit basis business than DoorDash. But if you think the dynamics can change and the scale and the efficiencies shared over time will improve and DoorDash gets anywhere close to Uber on the same level of gross order volume pricing, then this company will make a fortune in the future. The price of 73 billion is not going to look like a lot. It will not look like a lot. Now, when we look at other metrics here, again, the growth is phenomenal. We also look at the free cash flow. Let's look at a trailing 12 months to get a better, cleaner picture here. And if we look at the TTM here, look at the orders over the trailing 12 months, 2.47 billion. That's insane. Around 2.5 billion DoorDash orders in the past 12 months. And, this is the trailing 12 months as it's grown. So in the future, it's going to be much more with no sign of slowing down. We look at the EBITDA. They're finally EBITDA positive. They were in the negative. We look at the free cash flow. They're finally free cash flow positive. They were in the negative. Of course, you have to, with any company like this, you have to factor in the stock-based comp. Eats up a lot of the real free cash flow. It's a real cost to the owners. But regardless, you look at the free cash flow story here, and just consider the unit economics. If those improve at all, the scale that they're at, those improvements go a long ways to profitability. If they exercise any operating leverage, that'll go a long ways. Look at the cash balance, immense amounts of cash. Here's all their stock-based comp doing a little dilution. That's something I don't like to see. But overall, I think it's a really interesting business. I think that people should look at DoorDash a little bit more. And one thing I like about it is there's really no threat of Robo-taxi for DoorDash because they are a pure food delivery network. It doesn't matter how it gets delivered. So they're going to find whatever company will license any type of Robo-taxi. If Robo-taxi food delivery does become a thing, I think it's much further down the road that DoorDash gets disrupted than an Uber. So there's my thoughts on these couple companies. I just wanted to go through that. Hope you guys find it interesting. That's all for now.